So remember, we had introduced the whole of these basic concepts, and we say just a quick preview, looking at the basic concepts, one that you must always tend to have, and I'll always repeat this in each and every class till it sinks in very well. Looking at the basic concepts, we agreed that the following elements will be very vital. We said, number one, you must always tend to be very good when it comes to matters to do with 1A, this is taxable and non-taxable. I always repeat this, taxable and untaxable incomes. We have, of course, allowable and non-allowable expenses. We explained all this. We said that another key element we must also be very good at is for us to understand taxation of investments income. And these are where we talk about the aspect of dividends and interests. We talk about understanding the approaches of determining taxable income, approaches of determining taxable income. We talked about this. Another key element, we also agreed, we must be very good when it comes to capital allowances, as well as VAT. So we said when we are dealing with tax, we cannot go without this. Even as we proceed to the other elements, then we must always have this in our fingertips. So we cleared the first part, checked. The second part, checked. The third part, checked. This is part of our topic that we're going to handle. So the objective of today's class, we will be looking at capital allowances. In addition to capital allowances, there are other concepts before that which allow to take us through. Many a times at this level, whenever we are dealing with advanced taxation, there's one item which is always very keen, and that one you can do a check on your own. If at all you go through these past papers that we have, you'll always find that questions at this level, they'll always integrate it with the concept of incomplete records. They'll always integrate majority of the question with incomplete records. They assume, or this examiner will assume, you have already handled the component of incomplete records at the basic level. So what you're being tested at this point is what? Having a question. You're given a question complete, solve it. But I understand that some of us probably in class, maybe you did tax so many years ago. Yeah, a century ago, if so. So you'll find that when you're being tested at this point, the concept of incomplete records, majority, of course, connecting it back, it is always an issue. So that's why Mwalimu would always tend to look at it at the basic level, assuming that we did this so many years ago. So before we jump to capital allowance, it is not in your syllabus. They assumed you had looked at capital allowances back at your basic level. But in our class, we normally tend to look at it because it is very important. So this checked. Before we check at capital allowance, let us go and have a look at the concept of incomplete records in taxation. So that when you find a question or task, it will always be very easy. So we have incomplete records. This is also part of our basic component, incomplete records in tax. Incomplete records in tax. let me take you back on what we did. Anytime you hear about incomplete records, the whole idea is that this company or this business is not maintaining proper books of accounts. All times, whenever we hear about incomplete records, it is always about a business not maintaining proper books of accounts. That is always the case. So, in this level, you are expected to investigate these books. So you must be having the basic of understanding how can you reverse your car, how can you park the reverse gear, the aspect of incomplete records. So what will you be expected to understand when you're looking at incomplete records? There are three main elements that you must always tend to have in mind. The first element is for you to be able to understand the whole concept behind sales. Number two, understand the whole concept behind what? Purchases. And number three, understand the whole concept behind what? Cash. This is what our aspect will entail. The aspect of incomplete records, these are the three segments that you must always tend to have in mind. The sales, purchases, and cash. This is a foundation, this is a skeleton. This is a skeleton of incomplete records. So let us analyze the first part, sales. What will it entail? This is what we have. Anytime you talk about sales, we should understand that for me to determine my total sales, we'll always be talking of cash sales plus our credit sales. I remember like the last two sittings, that is of course August, of course actually no, the last three from December, April, August. You find that a lot of students in tax, they were looking at the paper and they were like, this is not tax. More so areas that we had a component of partnership. Why? The question was mixed up with the concepts of incomplete records. So if at all you don't have that knowledge, then establishing, of course, the first part will be somehow challenging. And that's when you'll find that yourself looking at, you start be looking at the ceiling, praying, which is very good. It's very about cash sales and credit sales. What will cash sales entails? This is what we should be having. When you're talking about my cash sales, at this point, we have banked cash sales plus unbanked cash sales. What are we talking of unbanked cash sales? What are we looking at whenever you are talking of unbanked cash sales? Excuse. Unbanked cash sales, you'll find that you've done transactions during the period. Then, instead of us taking this amount to the bank, I pay for other operational expenses. You find a company paying for some office expenses, you pay for maybe aspect of fuel, vehicle expenses, but whatever that you're using, it is from what you collected in terms of cash. So in the eyes of the taxman would be, yes, you are paying for these expenses, but ideally it was part of what? Cash sales. So that's why you're saying my cash sales will entail banked plus unbanked cash sales. Higher. Many a times you not be given the credit sales. Many a times you will not be given the credit sales. See this point? Many a times you'll not be given that. So if at all you're not given that, what are you expected to do? Anytime you're not given the credit sales, key components should always click at the back of your mind. the aspects of ledger control account. And you're talking about what? Sales ledger control account. So how will sales ledger control accounts look like? So we have sales ledger control account, sales / debtors or receivables, ledger control account. Yes, control accounts is in tax at this level. Control accounts, it is in tax at this level. Control accounts, it is in tax at this level. Normal balance for debtors, we normally tend to have it on the debit side. Yeah, I believe all of us, you must have heard, of course, if at all you've been following our classes, you must, all of us, you must be in love with Alice. Yeah, Alice. Any accountant must be in love with Alice. Any accountant must be in love with Alice. Someone to remind us who is Alice. Selena, who is Alice? Selena, who is Alice? Yeah? First of all, are you in love with Alice? Before maybe we go ahead, at this point, if I may ask, Lucy, are you in love with Alice? Do you love Alice?
Sorry?
Do you love Alice?
Yes.
Yes.
I don't know.
Alain, do you love Alice? Alain, do you love Alice? Mercy, you must be in love with Alice, right? Mercy, do you love Alice? Watu wanaogopa kusema. Yeah? Wilson, where if I told you in a position where you can talk, do you love Alice? Let me see who knows Alice. Ryan, do you love Alice at any given point? Ama tujui, like, labda mwalimu anauliza, if I told you are loving Alice, then people, most of ladies are like, how can I be in love with Alice? Yeah? Who can tell us who is Alice? Or why is Mwalimu saying that every accountant must be in love with Alice? If I told you you're not in love with Alice, you're not an accountant. Yes?
Mwalimu.
Yes, Phyllis?
Assets, liabilities. Hiyo nimesahau. Sijui hiyo si kama ni total and then expenses.
So Phyllis, what you're telling us is that you're in love with Alice. Yeah?
Yes, I do.
Phyllis, you're in love with Alice, right? Great. Every accountant must be in love with Alice. You see, because Alice is the foundation of accounts. And also tax has component of accounts. You can't know the normal balance it will be where, if at all, you're not in love with Alice. So this is what Alice entails. See, whenever you hear about Alice, you hear about assets. You hear about liabilities. See, you hear about income. You hear about capital. You hear about what? Expenses. And Alice will tell us that at all times, if I told you to look at the normal balance, all assets, normal balance will always be on what? Debit side. Normal balance for liabilities will always be on the credit side. Normal balance for income always be on the credit side. Normal balance for capital on the credit. Normal balance for expenses on the debit. The same Alice will tell us that whenever I'm talking about increase, Anytime your asset is increasing, we'll always debit. Anytime our liabilities is increasing, we'll always credit. Anytime my income is increasing, we'll always credit. Anytime you increase your capital, you'll always credit. And anytime your expenses is increasing, you'll always debit. But whenever we're having a decrease here, anytime your asset is decreasing, you credit. Anytime your liabilities is increasing, you debit. That is, of course, decreasing. Anytime your income is decreasing, you debit. Anytime your capital is decreasing, you debit. And anytime your expenses is increasing, you do what? Decreasing, you credit. This is the foundation of accounting. And this is the foundation of accounting. So at all times, I normally tend to say, if you are not in love with Alice, you are not an accountant. Because everything in accounts, including part of tax, you'll find that it will always evolve around this. So when Mwalimu is talking about normal balance for debtors are assets. So normal balance for debtors, we have it here on the debit side. So balance wrote down. We have it at that point. Look at anything that will tend to reduce my debtors during a period. At this point, we have maybe debtors will pay us. Yeah. So talk about receipts from debtors. See, you're having receipts from debtors. In this case, of course, after being paid, maybe you can decide to offer discount. So about discounts allowed. See, we have it at that point. Maybe you realize that, at this point, some debtors were declared bankrupt, so they will not pay you completely. So what are we talking about here? Bad debts. You sold some item and probably these items, in this case, probably the clients felt like they didn't probably meet the standards, or probably these goods were damaged. So they decide to return these goods to your company. Initially, you had recorded it as if these guys were owing you. But by the virtue that they are returning these goods to the company, it will decrease their amount owed. So talk about what? Return inwards. Or maybe some can term it as what? Credit notes issued. Say, so that as at the end of the day, we have balance carried down at this point, and eventually, in this case, what will we be looking at? Our balancing figure. Our balancing figure will be credit sales. And this is what I will be expected to determine in our sales ledger control account. This is what I'll be expected to determine in our sales ledger control account, where we have now what? The balancing figure. So anytime we are to talk of a value that you're given, in most of the cases, if I told you check, that should be April 2025, go back to December 2024, you're told that the company was not maintaining proper books of accounts. Then at that point, you start scratching your head, without knowing where you're going to start from. This is a secret. Incomplete records. So the first segment is just understanding how can you determine this missing figure, so that eventually, when we are talking about my total sales, we have the credit sales plus my cash sales will give us our total sales. Very important. Very, very important to note. So we have this element. Then we proceed to the component of purchases. And again, we see what will purchases entails. If at all you're having a question, this is the best time to ask before Mwalimu proceed to the next level. If at all you're having a question, This is the best time to ask, by the way. This concept, you're going to be my witness. You're going to be my witness. You're going to look at questions from our past papers. You guys are going to be my witness. They won't tell you that you're supposed to prepare sales ledger control. They will not tell you. The examiner will not tell you that you're supposed to prepare ledgers control account. But there are some leads. You see, the beauty part with these professional papers is that, however how much the question is complicated, you'll always be given a lead. Yeah? You'll always be given a lead somewhere. So one will ask, Mwalimu, now, how will I know that I'm supposed to prepare sales ledger control account? And I'm not told. So how will I know that I'm supposed to prepare the sales ledger control account? This is a secret. And this will always be your lead. Always try as much as possible to look at a lead. That is the secret of always passing these papers. Whichever computation that you're doing, the examiner will always give you a lead. More so these statement papers. So, at what point will I know I'm supposed to prepare sales ledger control account? Always make sure that you mark these elements. When you've seen an examiner giving you these elements. Number one, he'll give you what? The debtors balances. See, he'll give you debtors balances. Either you're given balance brought down or balance carried down. Once you've seen this, straight away at the back of your mind, be like, aha, why am I given the statements for as at the beginning and as at the end of the year? Meaning that there are things that happened in between this period that I am required to determine. So when given debtors balances, that is balance brought down and balance carried down, straight away, always kind of trying to bring this control account at the back of your mind. It will help you to identify what is missing. This is sales. What about purchases? What about purchases? Let us jump to purchases. Kindly, where you're having a question, make sure you ask. Yeah, where you're having a question, make sure you ask. So we have purchases. Again, same drill. Anytime you talk of purchases, my good students, you will be required to consider your total purchases. The question will be, how will we determine our total purchases? This is what we have. Total purchases. So total purchases, of course, the same concept where I'm talking about cash purchases plus our credit purchases. Many a times you'll be given this. Many a times you'll be given your cash purchases. Many a times you'll be given cash purchases. It will be upon us to determine the credit purchases. It will be upon us to determine our credit purchases. So the question that we need to ask ourselves then, how will I determine or how would we compute our credit purchases? This is the thing. We need to prepare our purchases, or simply creditors control account. Creditors control account. See? Purchases slash creditors control account. We know these are liability account. And we've seen for our liability account, our normal balance is expected to be on the credit side. So therefore, we have balance brought down on the credit side. What are the elements that will tend to reduce our creditors? I pay the creditors. So about payments to creditors. We're having payments here to creditors. In this case, maybe I'm given discounts. So about discounts received. At this point, maybe in this case, we have some return outwards. We have it at that point. Talk about balance carry down. We have it at that point. So that as at the end of the day, my missing value will be credit purchases. My missing value will be our credit purchases, which is our balancing figure. See, which is our balancing figure. This is what I'd be expected to determine. So that eventually, if we are to talk about my total purchases, we'll simply take the credit purchases plus the cash purchases. We'll simply take the credit purchases plus the cash purchases. So this is what we'll be required to do. This is what we'll always be required to do. Have that first, have that first. Credit purchases. You'll not be given if at all you're to deal, or rather if at all you're dealing with the aspect of maybe control accounts. We have this first, have that first, have that first. Where you're having a question, make sure you ask. Don't allow Mwalimu to proceed and yet you're still having an issue. So if at all you're having a question, this is the best time to ask your question. This is the best time to ask your question. This is the best time to ask your question. Very important, very, very important. Great. So once we have this, the next question, I know you know what Mwalimu is going to ask. I know you know what Mwalimu is going to ask. And having relating it with what you've done for the aspect of debtors, you can now give the solution here. To what point will I know that I'm supposed to prepare our creditors control account? Because the examiner will not tell you to prepare the creditors control account. So when to use the control account creditors, you'll always be given what? The aspect of payables balances or creditors balances. In this context, we'll be talking about you're given either balance go down or balance carry down. See, creditors balances you will be given. At that point, you know very well that at this point, I am supposed to prepare my creditors control account. Very, very, very important to note. Higher. What is the last element that we need to be able to understand when it comes to matters of our controls before we jump to our capital allowances? These are key elements. The aspect of talk about profit ratios. Yes, there are ratios in tax. There are ratios in tax. And specifically, at this point, we are talking about what? Gross profit or profit margin and markup, profit markup. At this point, remember, we selected tax because these are specialization paper and we want to do these things outside here. So when you're looking at it on a very practical perspective, you'll always get different scenarios. Amongst the scenarios that you'll always be experiencing are such scenarios whereby you need to establish or analyze the aspect of gross profit. And many a times you'll find that the profit ratios will always go hand in hand with incomplete records. They'll always go hand in hand with incomplete records. So we start with the first one. I want to erase this side. I believe that you're done. I want to erase this point. I believe that you're through. So these are what we need to have. These are what we need to have. We start with the profit. We start with the profit margin. Here we go. Profit margin. See? So when looking at profit margin, the whole idea here is that this is just a percentage of profit expressed in terms of what? In terms of sales. So when you're talking about the margin here, we are looking at our profit expressed in terms of sales. So what you're talking about here is our GP or profit of our sales. See, times whatever value that you're having, 100. We have markup. So for markup, ideally, we're about profit of cost of sales times 100. But why should Mwalimu tell us all this and we know? Why should Mwalimu tell us all this and we know? Because in an exam situation, there'll be a small twist. A very small twist. Say, for example, look at this case. A very, very small twist. And this, of course, even the students who are doing a FAR will also benefit. You're given, like, say, you have your sales 1 million, for example, and you have your markup. You're given a markup of 20%. Then you are required here to determine profit. What is our profit? You have computed your sales using sales ledger control account. You're given your markup. You need to determine profit because this profit is what you're going to use to compute your taxable income. So sales you've determined, you're not given purchases, but you're given markup and you're required to determine the profit. How will you go about it? This is the reason why Mwalimu wants us to learn something here. This is the reason why Mwalimu wants us to learn something at this point. So from what we are seeing here is that margin is expressed in sales. Here, I'm given my markup. So clearly, we cannot use sales and markup to determine our profit. What must we do? We need to learn how to convert markup to margin. That is why Mwalimu is reminding us all this. So, conversion of markup to margin, what do we need to have? We need to convert our markup to margin. I normally give it in a very simple case. Converting markup to margin, we add. I know one would be like, Mwalimu, now what are we adding? Converting markup to margin, we add. What will you be adding? That's a good question. So what in this case we'll be doing Like in this scenario of ours, my markup is 20 of 100, which clearly translates to say like 1 of 5. So if at all I want to convert my markup to margin, we take our numerator, we add it to our denominator. So to margin, I'll be having 1, 5 plus 1, which would give us our margin to be 1 over 6. Converting markup to margin, we add. What are we adding? We are adding our numerator to our denominator. We are adding our numerator to our denominator. 1, 5 plus 1. If I told it was 2, it could have been 5 plus 2. Very important. Very important. Very important. So like in our case here, I cannot use markup and yet I'm given sales. Because I know very well my profit margin is the one that is expressed to sales. So what are we doing? We are converting margin or rather markup to margin so that it can tally with what this is represented. So in this context, if at all I was then to determine my profit, we will take then my profit to be 1 over 6 times the 1 million there. That is what will give us what? Our profit in this context. What if it was the other way around? What if we are given scenario 2, this is cost of sales, these are of course these are cost of sales, then this is what? Margin. So we are supposed to determine our profit. This is scenario 2. We take 1 million to be our cost of sales, and this case 20% is our margin, and we want to determine our profit. We cannot use margin and cost of sales at the same time. So what will we be required to do? Convert margin to markup. Converting margin to markup, what do? We less. Converting margin to markup, what do? We less. So this will tell us my 1 over 5 is margin. So if at all I want my markup, therefore, I'll be taking 1, 5 minus 1. We less our numerator from our denominator. So that in this context, I'll be having my markup to be 1 over 4. So therefore, my profit in this context, I'll be having 1 over 4 times 1 million. Golden knowledge that Mwalimu has shared with us. A golden knowledge that Mwalimu has shared with us. If at all there's a question, kindly, this is the best time to ask. This is the best time to ask. This is the best time to ask. Where you feel, Mwalimu, to be honest, mimi hapa sielewi, naona giza. Naona giza. This is the best time to ask. This is the best time to ask. We have it. Where you feel you're having a question, is the best time to ask. We have it fast. Clear that fast. So that we jump to the other important element, which would be our capital allowances. Where you have a question, this is the best time to ask. Assuming that we are all okay. Now we can introduce capital allowance, one of or the last bit of our basic concepts before now we jump toward partnership. And from now henceforth, we find that even when we be looking at partnership, we'll just be referring back to what we did. Do you remember liable and unliable? Do you remember format of presenting our taxable income? Higher, we have interest or dividends. Are we talking of qualifying, non-qualifying, or exempt? This will always be our song. And that's why we started with the basic concept. So make sure if at all you've not followed our first, mostly second and third class, make sure you check that class. Make sure you check the classes. It will help us a lot to understand the whole basic concepts. So that moving forward, you'll find that now our task will just be referring back. We'll just be referring back. So at this point, allow me then to introduce this special area in tax. And this is all about capital allowances. At this level, Mwalimu will give us the basic concepts, of course. So we read about capital allowances. I'd explained the concept sometime back, but this is where we are going to analyze it, of course, in details. Capital allowances. Capital allowances, or simply, you can talk about deductions. And we're going to look again at the logic behind why we normally tend to say that the cost of an asset is taken as non-allowable, but the capital allowance is taken as what? Allowable. That is important because you're going to look at it at this point. First of all, let us understand the concept behind it. Because once we get the concept right, then moving forward, our task will be very easy. What is the concept behind capital allowance? That is what I want us to look at. What is the concept behind capital allowances? So the concept behind capital allowance, my good friends, let me do it with a demonstration here. You've gone and purchased, say, like a motor vehicle. The motor vehicle that you purchased, the cost of this motor vehicle, maybe you're really about, say, like 3 million. The original cost, the taxman will tell you as a business person that kindly don't deduct the whole of this amount from my, or rather from your income. What the taxman will do, the taxman will permit you, because these are capital investment, and they still want you to continue with your investment in that jurisdiction. So they'll agree, because we want to promote more investments, so of the cost, 3 million, take a percentage, say like 25%. Take 25% of that 3 million, which is giving us roughly like, of course, 750. So this 750, now deduct it from your income that you generated. So that, how will it help you? It will help you to reduce the income to be subjected to tax. So by the fact that I am granted the permission to deduct a portion of my capital expenditure, by that fact, that is referring to what? A deduction. Capital. Motor vehicle is a capital expenditure. Deduction that I am permitted to deduct from that cost is what we're referring to as what? The allowance itself. This allowance is vital because it will help you to reduce what you're supposed to pay as tax. So The whole idea behind capital deductions, we normally tend to look at, these are deductions taxpayers are permitted to deduct from capital expenditures. See, so we are saying that capital allowance for deductions, these are deductions taxpayers are permitted on their capital investments. On their capital investments. This is the whole concept. That deduction that I'm permitted to deduct from my capital investment is now what you're referring to as what? The capital allowance. So what are the types? What are the types? The types of capital allowance we have, major items that we'll be looking at, investment, deductions, what we normally refer to as ID. Number two, industrial building deductions. Industrial building deductions. We normally talk about IBD. And at this point, Mwalimu normally refers to IBD as Mr. Date. This is Mr. Date. I'm going to give a reason why we are terming it as Mr. Date. I'm going to give a reason why we are terming it as Mr. Date. Number three, we have wear and tear allowances, commonly referred to as WTA. Talk about mining allowances. Talk about shipping investment deductions. Shipping investment deductions. But the most common items of W, or rather the most common items of capital expenditures that we will be looking at, these are the first three. See, the first three are the items that we will be considering. The first three are the items that we will be considering here. First three. Very important and very, very key. The first three is what we are going to consider. So have it fast, have it fast. And where you feel you're having a question, as Morimo was said, don't hesitate. Don't hesitate. This is the best time to ask that question that you need to ask. Don't hesitate. So have this fast. I want us to analyze each and every item. Have it fast, have it fast. Want us to analyze each and every item, of course, at this point. We have it fast, we have it fast. We have it fast, we have it fast. So that we analyze the first component, which is what? Investment deductions. So we analyze the first case, which is what? Investment deductions. ID, commonly known as what? ID. ID, investment deductions. Where you have a question, this is the best time to ask, of course. ID. And over time, of course, there are so many things that have been changing in relation to capital allowance and also at this point. So we want to look at ID, and we are going to look at it in a very simple term. Of course, relating with the aspect of the items that will fall under ID. So even before we look at ID, there is key concept that I'll be referring a lot when I am talking about the capital allowances, what we normally refer to as qualifying cost. Qualifying cost. QC. QC, qualifying cost. In all the items of capital allowances, I'll be referring to qualifying cost many times.
We lost you. You're not audible.
Yes, now it should be audible, right?
Yes.
Yes. So we're saying that when we are looking at qualifying cost, what do we need to understand here? Qualifying cost, simply, we are considering the cost to be subjected for capital allowances. Cost to be subjected for capital allowance or deduction. This is what we normally refer to as what? Qualifying cost. Cost to be subjected for capital allowance or cost to be subjected for capital deduction is what we're referring to as qualifying cost. QC. 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 Very important. Very, very important. Very, very important. So let us look at investment deductions. What are these type of costs or items that will be subjected to investment deductions? A very brief one now. In a very brief manner, we can briefly mention and say that investment deductions or ID simply because now we know anyway what ID tells. These are deductions granted on the following capital expenditures. Deductions granted on the following capital expenditures. Deductions granted on the following capital expenditures. Number one, we are looking at factory building. Talk about factory building. We're having the factory building here. Talk about factory building. Hospital buildings. Hospital buildings. Cost. Petroleum storage facilities. Petroleum storage facilities. Petroleum storage facilities. Number one item. We're looking at, of course, these items, majorly factory buildings, hospital buildings. I talk about petroleum storage facilities. Main item, we're listing it. Main items. Number two, we're having hospital equipments. Hospital equipments. Hospital equipments. Hospital equipments. These are also subjected to a D. Hospital equipments. Number three, we are looking at machines used in manufacturing. Machines used in manufacturing. Machines used in manufacturing. Machines used in manufacturing. For example, we hear about processing machines. Processing machines. Talk about packaging machines. Packaging machines. We hear about weighing machines. Weighing machines. Weighing machines. Weighing machines. We talk about conveyor belts. Conveyor belts. Conveyor belts. Conveyor belts. Etc. In your own judgment, my good students, you look at this machine, ask yourself, how is this machine helping us in manufacturing? If you get a question to that and you're dealing with a manufacturing firm or company, just know that you are supposed to take it under what? ID. With your own judgment, look at a case, ask yourself, how is this machine helping me in manufacturing? If you find an answer, put it there. Number 4, incidental costs relating to the purchase of the machines above. Incidental costs relating to the purchase of the machines listed above. Incidental costs relating to the purchase of the machines that we've listed here. Incidental costs. A good example of incidental cost, someone, I know you know what incidental cost is. Number 1, incidental cost. Jack. Incidental cost, I know we know what incidental cost is. Someone, unmute and tell Mwalimu an example of incidental cost.
Installation cost.
Very good. We put that one down. Installation cost. Number 2. Someone. Number 2. Yeah.
Maybe
Insurance on
Pardon?
insurance on transport.
Great. Insurance in transit. Good. Insurance in transit. Good. Any other incidental cost? We told installation, insurance in transit, see, the transport itself, yeah, offloading and offloading costs. See, all these are the costs that are associated with the purchase of these machines. Before we start using these machines, what were the costs associated up to the point that I was using this other than the purchase cost? See, these are what we're referring to as incidental costs. We have auxiliary cost to manufacturing, auxiliary cost to manufacturing, auxiliary cost to manufacturing. In a very simple term, I normally tend to look at this as what alternative cost, so that you can be able to understand. We're saying that these are auxiliary costs relating to manufacturing. And normally we're saying that in a very simple term, I normally tend to look at it as an alternative. Say, for example, maybe you are in a manufacturing area. Then probably by bad luck, maybe of course, because of all this power fluctuation, maybe you lose power. What would be the alternative for power? Using power from the main grid, what would be what is the alternative of power? Mnatumia stima, bahati mbaya ipotee. In a very layman's perspective, what is the alternative?
Generator.
Very good. Tutatumia generator. See, or maybe in this case, you are so used to the running water from the taps. Bahati mbaya kanjo wakate maji. What would be the alternative? What would be the alternative? Boreholes. Utachimba kisima. Boreholes. See. Or maybe you can decide to purchase water pumps. So what Mwalimu is talking about as auxiliary cost manufacturing, we normally look at them as simply alternative costs that you can use other than what is the normal case. See, so auxiliary cost manufacturing, e.g., generators, water pumps, boreholes, you can talk of transformers, etc. Auxiliary cost manufacturing, where we read about generators, boreholes, water pumps, of course, transformers, etc. What is the other cost here that we should also be able to understand? Civil works, like about some certain civil works, e.g. of civil works that we're talking about here, we're having loading bay. See, loading bay. Loading bay will work as part of the civil work here. So they're about loading bay, loading bay. We have parking bays. If at all these parking bays are within what? Are within our area of manufacturing. So they're about parking bays. Parking bays, that is also key to note. Parking bays. Parking bays, very important to note. Parking bays, very important to note. Talk about perimeter walls. Perimeter walls. Perimeter walls. Perimeter walls or security wall. Security wall or perimeter wall. Also part of that. So these items that we've listed here, anytime you see such an item and you're having or you're dealing with a manufacturing company, just straight away know that what the good examiner wants you to do is to make sure that you accounted them under ID. That is very, very important to note. Anytime you come across such items, just know that you're supposed to consider them under ID. Higher. The next important element here is what are the rates for ID? Talk about the rates for ID. Talk about the rates for ID. What are the rates for ID? This is what we need to understand. And at this point, be very, very tentative. At this point, be very, very tentative. When you are talking about the rates for D, this is what we need to have in mind. We have 50% the first year, 50% the first year. We have 25%, 25% on cost, 25% on cost of the residual value. 25% on cost of the residual value. 25% on cost of the residual value. This is the case. Take this example. We are having cost of the factory building. Maybe cost of the factory building, we're about say like 2 million. So about 2 million. This is the original cost. So when dealing with ID, this is what we are saying. The first year, which is year 1, we are going to take the 2 million times 50%, which will give us what? ID will be 1 million. This is ID. So that my residual value, I'll be talking about 1 million. What will happen to year 2? When we go to year 2, my value for ID, I'm going to take the residual value, 1 million now, times 25%. Year 3, I'm going to take 1 million times 25%. We're saying on cost. Year 4, 1 million times 25%. See, that's what you're saying. Year 1, 50%. 25% on cost of the residual value. These are preceding years. See, 25% on cost of the residual value on the preceding years. See, preceding years. So this is what you're looking at. Year 1, 50%. Preceding years, we take 25% on cost of the residual value. The residual value is the balance that I'm going to remain with after year 1. After year 1. And where you're having a question, make sure you ask. Where you're having a question, make sure you ask. This is the best time to ask. Best time to ask. Yes. Any question? Where you're having a question, make sure that we ask. You're having a question, make sure that we ask. We're having a question, make sure that we ask. Great. So once we have achieved this, the next element would be what? A very important component here, which you are going to have it as an NB. We have it as an NB, a very important element, which will guide us all through anytime you're dealing with what? ID. So we have an NB here. I know I've not given you a break, but Molimu is almost done. I know I've not given you a break, but Molimu is almost done. So we're having to talk about NB here. NB, it is this person that you normally refer to as the 10% test. 10% test. 10% test. This is our NB, talk about 10% test. What about 10% test? What do we need to understand? What do we need to get it right? Anytime you hear about the 10% test. So I want us to mention something here and say, this test is applied. This test is applied when the following items are included in the cost for the factory building. This test is applied when the following items are included in the cost for the factory building. What are these items that you're talking about here? The items that you're talking about will include, number 1, talk about aspect of admin block. Talk about retail shop. Talk about showroom. Talk about dwelling place. So these tests apply when these items are included in the factory building. These tests apply when these items are included in the factory building. The factory building. Full stop, we can add and say that the purpose is to determine their materiality. The purpose is to determine their materiality. The purpose is to determine their materiality. Another dash. we can mention say still under that. If the cost of these items, if the cost of these items are more than 10%, if the cost of these items are more than 10%, of the factory building cost, are more than 10% of the factory building cost, they will be deducted. They will be deducted. They will be deducted from the factory building. They will be deducted from the factory building. They will be deducted from the factory building. They will be deducted from the factory building, and therefore not qualifying for ID. 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 But if less than 10%, but if less than 10%, but if less than 10%, they will not be deducted. But if less than 10%, they will not be deducted. If less than 10%, they will not be deducted. That is to say, if they are not going to be deducted, it means that what? They will qualify for what? For ID. If at all you're not going to deduct this from a factory building, it means that they are going to qualify for ID. So that's why I'm saying, but if less than 10%, they will not be deducted. They will not be deducted. Something very important that I want us to add here, and this will always be our guide. Another dash. If possible, have that with a different pen. If possible, have that with a different pen. If possible, have that with a different pen. If the above items are given separately, if the above items are given separately, in essence, they are not included in the factory building. If the above items, the one that we've listed, if the above items are given separately, in essence, they are not included in the factory building, they will qualify for IBD. If the above items are given separately, we're saying they will qualify for IBD. Very important to note. If they're given separately, they will qualify for IBD. Very important to note. Very, very important to note. So look at this example so that you can be able to get this right. Look at this example so that you can be able to get this right. I am given my factory building. We are given our factory building here. My factory building, I am given at this point. Factory building at a cost of say 10 million. Included in the cost, we have showroom, 1 million, admin block, say like 1.5, and maybe say like a retail shop. We can just take this 3 anyway, say like 500,000. The factory building cost is 10 million, but included in that factory building cost, we have these items. Cost of showroom, 1 million, admin block 1.5, and a retail shop of 500,000. So we are required to determine the qualifying cost. Determine the qualifying cost for the factory building. Determine the qualifying cost for the factory building. Determine the qualifying cost for the factory building. What are we going to have? Determine the qualifying cost for the factory building. What are we going to have here? We conduct 10% test. Why? Because there are these items that we listed included in the factory building. So how would we go about our 10% test? We have our factory building going at how much? 10 million. Conducting this test, what will we be having? We take non-qualifying items. Among these items, we have the following: showroom, that is 1 million. We have admin block, that is 1.5. We have retail shop, that is 500,000. So total, we can talk about what? 2 million. What we want to do is to conduct this test. Of the total factory building, the total cost of these items measured into percentage. What is the percentage of the total cost of these items to our factory building? What is the percentage of these items to our factory building? So therefore we have what? 2 million of 10 times 100%. We want to determine, in this case, of the total, what is the percentage of the total cost of these items to a factory building? We get like 20%. So already 20% has exceeded the 10% mark. And if it has exceeded the 10% mark, what we are going to do, we are going to remove it here. So that we say my qualifying cost, we say that our qualifying cost, therefore, in this case is 8 million. So if at all I was to provide our capital allowance on the factory building, we are going to provide on the 8 million. Remember, Mwalimu talked about qualifying cost, the cost to be subjected for capital allowance. So in this case, you're going to provide our capital allowance on the 8 million and not the 10 million. Again, this is what we must be able to understand clearly. Once these costs have been deducted here, they will not appear anywhere else. Kindly, if at all you can note, we note this. If the cost of these items are deducted here, they will not appear anywhere else. They will not appear anywhere else. Very important. Once we have deducted these costs from this point, they will not appear anywhere else. That is a very important key component that you must be able to master very well. The moment I have deducted these costs here, the They will not appear anywhere else. They will not appear anywhere else. What if in this case we had a value which was less than 10% or 10%, say we had say like 9%. If the cost of these items maybe were 9%. If at any given point I have worked out the total cost of these items and we determine it is 10% and below, that is to say my qualifying cost will still remain to be what? 10 million. Because I'm not going to deduct this cost here. If at any given point I've worked out and I've determined or I've seen the cost of these items are less than 10% or 10% and below, that is to say I am not going to deduct that or the amount from our cost. And we clearly stated if they are not deducted, then they will qualify for what? For ID. I need a question. I need a question. You can either chat, but I always encourage you on mute, you ask the question so that it will be direct. Where you feel like Modimu should explain further, then this is the best time to ask, because the next thing is Mr. Date. The next item is Mr. Date. Any question on this? Any question on this? Yes, please.
Please, can I ask, so if they will not be deducted, so that means they will be deducted somewhere else, right?
Not really.
Okay.
Look at this case, Lucy. The moment we've said that they will not be deducted, assuming we've worked it out and we've seen it is 9%, right?
Yes.
That is to say, the cost that I'm going to subject for ID will be what?
10 million.
10 million and not 8 million. So
Yes.
that is to say, by the fact that they are in this 10 million, they qualify for what?
ID.
ID. But if they are more than 10%, that's what you said, they are going to be deducted and they will not appear anywhere else. And that's why I insisted on that point. So if less than 10% or 10% and below, they will qualify for ID. And if I told you to look at it practically, that is to say they will be part of the capital allowance that I'm going to deduct from my income.
Okay, thank you.
Is that clear, Lucy?
Yes, thank you.
Great. Any other question, guys? Where you feel like you're not understanding, make sure that you ask. This is the best time to ask. The next element, which we're going to do it in our next class, that will be what? Mr. Date. Next item you're going to do it, that will be Mr. Date. Let me see. Yeah, Christine, remember, like at this point, they are by the fact that I think that's the same thing that I've told Lucy. By the fact that they are in ID, remember ID is capital allowance. And capital allowance, in this case, they are tax deductible. Capital allowance are taken as liable expenses, and they are going to be deducted from our, of course, statement when you're preparing the taxable income. So, by the fact that they qualify for ID, they are going to be taken as capital allowance and deducted from our income to arrive at the taxable income. Right? So you guys, if at all there's no any other question, Molimu will want to wish us a very good night. Next class, we are going, this will be objective next class. We are going to clear capital allowance and introduce partnership. We're going to clear capital allowance because now IBD is very short, WTA is very quick. So in our next class, we're going to clear the capital allowances and we introduce now aspect to do with taxation of partnership. which majorly will just be referring to whatever that you've done at our basic level. So at this point, you guys have a very good night and see you in our next class. Bye-bye.